everybody. Welcome to the Web3 Business Show brought to you by Tokenizing. My name is Rob, and as usual, I'm joined by my colleagues Edgar and Kay. Hello, welcome, guys.
Hi.
And today we have two amazing guests to help us cover the RWA topic. Welcome, Arnoud. And Stefano, who's been an earlier guest on this podcast as well.
Nice to be back. Hi, everybody.
Yeah, guys, so let's dive in right away. Maybe we can start a little bit in the introductory phase of what you guys are doing yourself in the RWA space. Let's start with Arnoud on that one.
Sure. So I'm actually doing it two things. I'm looking at both the asset leg and the cash leg, as we'd like to call it. I think one of the big promises of blockchain technology is delivery versus payment, automating delivery versus payment, atomic swaps, removing intermediaries from the settlement processes, right? And I think we'll talk a bit about that. So on the one hand, I started looking at how can we look at financing commodity flows like oil, copper, wheat, coffee, etc., and which is quite a lucrative business, financing that, and transmit that yield that asset managers get on chain in the form of a yield-bearing type stablecoin. Now, as I started looking at that, I thought, there's one aspect that we need to think of as well, which is the cash leg, particularly as this enters the field of securities, and then moving from a highly permissioned product, settling it with a permissionless product might be a bit tough for regulators to follow, right? So, I came across this company close to where I live actually, and they're issuing a stable coin, which is permissioned, but which is on a public blockchain and is fully compliant with the upcoming regulation in Europe called MiCA. And so the exciting thing for me is looking at both those legs and bringing them together. And one of the other projects I'm starting to work on with the company in the Netherlands called Quantos is enabling this automatic settlement of security transactions on chain without any lag in there. And so that's what I'm working on at the moment.
Okay, so the projects regarding the euro stablecoin, you also consider in the RWA category, or?
I think so. Yeah, sometimes it's excluded, sometimes it's not. But in reality, it is cash. Cash is an asset that is not native to the blockchain. You can put it on a balance sheet, and a stablecoin is a tokenized version of cash in a way, right? And therefore, for me, it's a real-world asset.
Okay, understood. And Stefano, what can you explain to the audience? What is your involvement in the RWA space?
So, I run a filing agent. So we do company corporations, and the particular thing. So what we do is that we have developed a framework to tokenize shares of private limited entities. We operate in few offshore countries. Seychelles, Panama, BVI, Singapore, Belize, San Vincent and Grenadine, and Wyoming in the US. In a nutshell, we actually help people that wants to do tokenize projects to set up the legal structures to basically go live. And so we might help gold miners that needs to tokenize actually physical mines or intellectual properties or real estate, both commercials and individuals, real estate, commercial properties, IPs, anything that basically you really can touch or that you can own in one way or another. We can help people tokenize that, and that's what we've been doing since 2018 at this point.
So that includes commodities as well.
Yes, not as obviously as a custodian point of view, but we do have some projects that might have Arnoud was mentioning, for example, like the grains. We do have a project that is relating to coffee, for example, and they did have tokenized tons of coffees to kind of like bypass the futures and kind of like all the FX markets and so on. So yes, also on pure commodities, we do those things.
Okay, right. Ed and Kate, do you guys want to jump in at this point?
Yeah, I have some questions. Any one of you can answer. So, recently because I'm also talking to a lot of clients. I'm also talking to a lot of projects. So mostly, I think about 60%, if not around half, 50% of them are jumping into RWAs. So, what do you think, guys, are the primary benefits of tokenizing real-world assets and bringing them onto the blockchain? So, both for investors and asset owners. And following, just a follow-up question on that, how about the liquidity? So, how does tokenizing RWAs improve the liquidity compared to traditional methods of asset ownership?
Wow. Good, great questions. Shall I give it a go, and then Stefano, you can
Please.
go after that. So, I think there's. If we go back to the definitions first, like for me, there's RWA are basically the complementary part of crypto assets. So crypto assets are also assets, but they're born on a public blockchain. In essence, it's a data field with some value associated with an address, and cryptography helps ensure that only one entity can actually, which can be a person or a device or an algorithm, can change that address, right? They have the private key to do that. For me, tokenization is creating a digital representation of rights to an asset. So in the sense that if I transfer the token, I transfer my rights to the underlying asset. So actually that crypto asset technology is pretty useful for that mechanism, right? Because you've got only one owner who can transfer that right. RWAs are essentially, for me, assets that are not born on the blockchain, i.e. they can live and breathe and have value even if the blockchain is down, right? They don't need that representation to have value, but it changes things, right? Because it's and that can be anything like art, wheat, coffee, but also financial assets, stocks, bonds, loans, etc. So for me, those are the key components, and tokenization is a fantastic mechanism to see if you can bring that right to a particular asset on chain and creates it digital and make it digital. Because the benefit you get from that is you can start transferring rights without having to instruct a third party to do that. That third party would normally then take the paperwork, check it against all kinds of registries, do KYC on you, do KYC on the other party, etc., etc. There's a lot of reconciliation effort that takes place, and that makes it expensive to execute that transfer. So you wouldn't do that for small things. But with this one, you actually take away the need for a lot of the paperwork in terms of the transfer of the asset. Therefore, you can start, it goes faster, it costs less, and the incremental cost of doing it is a lot lower, right? So you can create more, you can do very small transactions that would not be economically viable in the previous way of doing it. Now that in itself, and that's fractionalization, that could create liquidity. This is your second question, but it doesn't. It's a secondary market that creates liquidity, right? So ultimately, so unless there's a secondary market, then it's very difficult to. Let's take an example of a tokenizing a painting, right? Fractionalizing it. Just by cutting it up into small pieces doesn't mean that it makes it liquid. In fact, if you're a holder of a fractionalized piece of a painting, you're worse off. You don't have the painting and you can't enforce any rights unless you collect all the other ones. So that's shows why the tokenization journey is following a path of the most liquid assets being well-established secondary markets to less liquid assets. So we're starting with cash, moving into bonds, moving into money market funds. Soon there will be equities. I think you see that more and more already, and then you start seeing, and I'm talking about public equities, and then you start seeing probably private credit, and then you start moving down the chain in terms of that adoption cycle. But yeah, so tokenization, fantastic mechanism to remove costs. Increase speed, but it doesn't solve the liquidity problem.
All right. Okay. Thanks, Arnold.
I'm a bit on the opposite side, to be honest, on the final part, on the liquidity side. But on the first part, I completely agree. Giving you like an example on like more of an actual real world case, there is this project called Moo Track. And they're literally doing tokenizations of cows. This is not a joke. And so you have the option of basically buying and selling cows. And the very cool thing about this is that you don't only tokenize the asset itself, but because like the cow itself is on the blockchain, and so the history of the cow is on the blockchain, you know when you're purchasing that or when you're exchanging that, all the history of the cow. So where it was born, how it was raised, how it was fed, and so on. What Arnold is mentioning is very true, that like when you're going cross-border, when you're going like into different countries, not only you have different individuals, different stakeholders that needs to update every single item every single time, but you also have the problem that you have different regulations, you have different languages that are spoken, you have different processes. Sometimes the form that has the same information might be different, just like from a design point of view, and in some cases it just get rejected because of that. And so what you can do by tokenizing items in general is giving that a sort of a standard on which the history, it's always there. And so you don't need to constantly making sure that someone is checking those type of informations, and it's like making sure that, you know, all the forms are updated, all the informations are there. If you have 10 documents, that those 10 documents are always sent out at the same way, and so on and so on. So it does simplify your life a lot. On the part of the liquidity, I'm taking it as example. I don't remember the name specifically, but there is this project that allows to tokenize watches, so luxury watches and so on. And if I'm taking that as an example, let's say that I have in like an AP or a Patek Philippe or a Rolex or whatever. I live in Singapore, which means that my immediate market would actually be the Singaporean market from that sense. Or I would need to use like something like a Chrono24, so a website, a service provider that is currently available, in which like it's a marketplace and so on. But that sort of solution allows me only to sell the product directly, and so I can basically find a buyer, and I can interact with that buyer, and that's it. But what I'm able to do from a tokenized solution is basically having that watch that becomes a token, and now I can basically use that token as a collateral, for example. And so that allows a person that maybe doesn't want to get the watch itself, but to give me a loan in return, like on an interest and so on. And if I default on that loan, then I receive the NFT, the tokens that represent that ownership of that watch. And that entire NFT can exchange hands in a very quick way and can be collateralized multiple times without never actually moving the watch itself. And that is something that without a tokenization model is not possible, which ultimately it should increase liquidity from that specific product. If we're looking at commodities and so on, that's like obviously an environment that I'm less familiar with. But if I'm thinking about like physical items, like it could be watches, it could be Lego boxes, that is another collectibles items. It could be like high level clothes or bags and so on. Those items, to me, if they get collateralized and they get tokenized, they actually increase their liquidity compared to just having the physical item in hands.
I think I liked it. That analogy, and I looked at a lot that topic, and there's two types of products if you tokenize. You've got commodities by nature. like let's say physical commodities, there is a liquid secondary market. You can always, if you use it as collateral, and commodity trade finance is based on using physical commodities as collateral, it's fine because you know that you can always sell it. Right? There's a ready market and you can predict the price. There's sufficient price discovery. If you use a watch as collateral, I think the first step is fine, but what if you have to enforce your collateral rights? You need a secondary market to sell the watch into. And if that market isn't liquid, then you are selling at a massive discount, which is why lenders look at collateral and they apply a haircut quite often of 80 to 90% because they are not sure that they can actually realize the value of the collateral if they need to liquidate, right? So that's sort of what I mean. If you can create liquid markets for items that are that serve as collateral, then it's fantastic. But those markets are not there yet. That's the challenge.
That is like we're still at the not at R&D level, but I would say as a public alpha or maybe beta stage. Like we're far from where we should be in terms of like proper delivery and usage.
Correct.
Amazing, guys. Lots of things to cover, to jump in here. But Ed, maybe you want to go first from a more technical perspective.
Yeah. So my question is not actually technical, but here it is. It seems like everyone is jumping into RWAs. Why do you think is that? And what do you think makes an RWA project successful?
That's a $10 billion question. If I knew, I would have a unicorn by now. I mean, I think that ultimately it's one of those scenarios in which like the same parameters that makes any project successful stays in place here. And so apart from the very generic, the team needs to be capable of understanding what the project is about and so on and so on. I think that a very, very important component here is the legal aspects of that. You do need to make sure that your custodian, if you're doing, depending on obviously like the type of tokenization that you're doing, but obviously your service providers needs to be in place. So your custodian, your lawyers, your regulators, your registers, everybody that is like involved, or your banks and so on and so on. You need to be standing next to companies and entities that in general like have a solid reputation and that they understand what they're doing, because multiple times you end up in situations where like people don't really go in that direction and they were just like trying to do something to grab the money and so on. But apart from that, you need the market in reality. Because I think that like one limitation of where we are right now in the space is that you can see that what is happening in the crypto market. There is kind of like the meme coins wave and so on. It's pure speculation and so on. Tokenization brings real benefits on the plate that I don't think the industry and the market itself is completely there yet. So once people mature to the point of starting having maybe bad experiences or being upset of like, paying high fees and so on, and start looking for alternatives, then they can start utilizing some of these services, and therefore markets get created and can enlarge and so on. That is obviously the job of the team. They need to do a proper communication. They need to look for their personas in the proper way and so on. But realistically, the difficult aspects of doing a project or doing a startups or building a company are the same no matter what's the sector that you're building up in reality. The challenges are very, very similar in personal opinion on this.
Yeah, I agree with pretty much everything of that, right? So I think one of the challenges in this distributed world as well is that if you're tokenizing assets, you're basically changing the way an industry works, and network effects are going to be firmly against you, right? And the more participants in the transaction, the more parties need to change, the more reasons not to change. So selling a solution into this market is not so much about convincing people that this makes a lot of sense, that it's better, faster, cheaper, but it's more removing reasons not to do it, and that's a lot more work. But that's what it takes to get successful. And then, of course, the legal environment is incredibly important, because if you tokenize an asset and you cannot enforce your right in court, it's pointless. It's just a hobby. So the legal system really needs to support that. But I guess the other thing is, tokenizing real world assets is probably a very broad term. So if you say what makes a project successful, other than the usual startup aspects, but it depends on your objective. How do you measure success? But if your objective is to create a very successful product in a highly liquid market, yeah, you need market liquidity. Right? But if, like the example that Stefano used, so I've been building ventures in physical commodity supply chains for a long time. Right? And tokenizing the underlying commodities is hugely valuable exercise, because every single transaction, transferring ownership from one unit of commodities to another party, can involve 20, 30 parties, right, that need to process information. It's the banks, it's the financial markets, it's the logistics providers, it's the service providers, it's the inspectors. Everybody needs to do their bit, and everybody is moving data around. They take in one form, check it against another form, rekey it into another form, and then send it on into a fourth form. Right, so that's what happens, and every step creates more versions of the truth. That creates an enormous amount of complexity and reconciliation effort in operation. So by tokenizing the underlying commodity, the provenance, all the digital content that belongs to the physical material, and make sure it's always real time, always up to date as it moves along, that removes reconciliation, removes enormous complexity in back offices, makes it easier to move it across borders. So that type of tokenization is a fantastic use case of blockchain technology. And if you can do that well, then that's successful. Doesn't make the other aspects less important in terms of adoption and those things, right? So.
All right, thank you. That's all for my question.
Yeah, so I think we can take away from this that RWAs are not a quick win for any project, but it's a uphill battle worth fighting, getting the network effect behind it, like you guys are explaining. Man, there's so many things here to get into, but let me just kind of lighten it up a little bit first with a bit more superficial topic. USDT, or rather Tether as a company, they just launched the gold-backed token. Any opinions on that?
It's a well-defined use case. It's been done a number of times. Paxos was one of the first, and you've had multiple other parties doing it. See, for me, gold is a financial asset. It's not actually, I see it more as a financial asset than a commodity. So in that regard, it's potentially a bit more like equities or cash in a way, right? So given that Tether is tokenized cash, it's a very small step to tokenize gold. Now, I guess if you have the same user community and they can choose between multiple commodities, cash, US dollars versus gold, I think that's going to that's going to make the decision in terms of adoption. But in the end, gold is always denominated in US dollars, right? So it's a bit of a circular thing. So if you want to buy Tether gold, you're going to mark to market it probably in Tether US dollars.
Right. Before Stefano jumps in here, just to clarify, right, for the audience. So Arnoud, what do you think will determine the adoption? Can you mention that again?
Whether people see it more as a stable value than US dollars. If the inflation rate in the US dollars goes up, becomes more like the Argentinian one, then obviously gold is a successful alternative.
And what is the downside then by having it denominated in USD? What you mentioned, if it's let's say something to protect against inflation, right? What would be the problem with having this type of trading there then?
No, there's no problem. It's a choice. I mean, you give optionality to users. I mean, every option fragments liquidity, but it also creates new use cases. I guess the other aspect is that, let's maybe the US dollar, US government's view on stablecoins may be different in the future and may put rules just like European Union does on what is allowed and what's not. Maybe US dollar cannot be basis for a stablecoin in the future. There could be other reasons for doing this, right? There's diversification.
But from an RWA perspective, right? What would be, because if you're tokenizing, and again, Stefano, feel free to jump in on this one. I know this is your area of expertise as well. For our audience, right? If you're tokenizing something like gold, we just discussed the new European regulations. We also we didn't really go into any other type of KYC for certain assets that you're tokenizing. What is the difference here? If you're tokenizing something like gold, and you have what Tether has, well, in this case, very bad terms of conditions around it, but do you need to KYC people on that assets, or where lies the actual distinction between tokenizing assets that you need to have a KYC wallet system for and stuff that you can just freely trade, like the Paxos stuff and the Tether stuff?
It's the difference comes to like if you can redeem that or not. And so if you just, because like one thing that is extremely important on the tokenization is like defining if they're tokenizing just a paper one, which is the product normally issued by a bank and so on, or if they actually have like a storage room where they physically like put the gold in and so on. Considering how Tether operates, I don't really see that happening, to be honest, but you know, maybe. But apart from that, like if you just tokenize the token itself, you can literally trade that, because on per se, the big difference is like what the token carries. Does the token gives you any real benefits out of that? Does it entitle you to receive something? And so let's say that it could be like a stock, just like for simplicity, it could be like, does that allow you to receive a dividend? If we're considering the gold part, does that allow you to redeem the physical gold? And so when the redemption happens, that's when the KYC in theory should kick in. Now, it depends a lot on the country where the gold is located, because different countries have different rules on who can purchase, could sell gold, and so on and so on. But as a macro level, that's when you will do the distinction. As long as you're just trading that and it represents a piece of gold, a gram of gold, and so on, as has been done. Arnoud has mentioned that, but literally, like, this is like so old. Like, I'm so sorry, but like we've seen that since the first ICO wave. Like, tokenization of gold is really like nothing new on this. And like any other project, it will work exactly the same way. As long as you don't have that ownership of the underlying asset, you can totally trade it freely with no problems.
Okay, so is this in any way also linked to the kind of the security classification, like this whole debate that's not debate, but the SEC classifying, for example, Bitcoin as not a security, Ethereum potentially not a security, other cryptos are securities. Is that linked to that, or you don't necessarily need to have a KYC integration for any security that you're trading on the blockchain?
It depends, because the gold itself would go under commodity, not as security. So different rules and different regulation. If we're considering the security rules itself, then yes, at least like in the US, but like pretty much everywhere in the world, regulations around securities is very, very clear. The big misunderstanding that has been going on for many years is that people think that when something happens on the blockchain, magically it loses any legal property, which is obviously not the case at all. There are some projects, for example, in the US that would do like tokenization of real estate, and they would try to sell you pieces of LLCs that basically own real estate inside. You do need a license to do this in the US, and a lot of these companies don't have the licenses, obviously, and people are as an answer or as a reply use the fact that, oh, but it's still everything is running and so on. That doesn't mean that it's legal, or it doesn't mean that it's fine. Like, you know, that there are set of rules that are in place for that. If you have the classical questions in regards of a security, and therefore it is like, are you the main one is the one relating to, are you gaining an interest, or like, are you getting richer by owning this through the works that has been computed by other people and not yours, which is traditionally what gets translated with the dividends. You know, a commodity doesn't have that, a securities does, and so it's a little bit different from what Tether is doing.
Is the commodity in general, no, as long as you don't actually exchange it for the actual asset, then there might be some KYC. In general, it's freely tradable, whether it's gold or whatever commodity we're talking about. Sorry, Arnoud, you want to jump in?
No, that's true. It's an interesting discussion, though. I mean, we're looking at that with our Euro stablecoin. We have a discussion. There's no discussion around the on-ramp and off-ramp, right? You need to whitelist and identify parties and KYC them if you take their money or if you give them money, fiat money. That's the given. But the KYC aspect in between is a question. On the one hand, we have the permissionless role that say we don't care what you do with it because it means nothing until you turn it into cash. Now, there are examples where something that is in theory meaningless can be traded, can be used for nefarious purposes, right? All the reasons why they try to limit cash, usage of cash everywhere regulated. So the question is, are you going to allow that? And then if there's some authorized participant that has the right to redeem it and is trustworthy, then it's all fine. I just don't see it. If we're talking in the RWA context, I see it working in crypto, and crypto is fantastic. It's today a $2 trillion industry of hope, right? And it's but if you want to bring on board let's say the 800 trillion in assets that are out there, it's a big financial institutional industry. There's different rules, right? And just to that promise, that scaling, unfortunately, compliance is reality. You need to have the compliance, you need to have KYC, you need to understand who is holding what, and it's not a world of bare instruments. It's, in fact, the beauty of blockchain, I think, is it enables you to digitize the complexity of compliance and the effort involved in compliance and automate that process and make it much more seamless. And that's what we should focus on, rather than trying to figure out how can we avoid security rules and AML rules and stuff like that, because that tends to be most of the energy going into some of the crypto projects is in avoidance of treating it like security rather than figuring out how to make a skill as a security.
What is your opinion, if I may ask? Because it is true what you're saying, and I completely agree on that. But doesn't that push towards the same regulation that we have on where the vast majority of assets are going to end up being allowed only to accredited investors? Wouldn't the fact that, like, because we have crypto and things makes easier things, that therefore we could have a little bit of a easier type of regulation? Or is the current structure like going to be copycat 100% and it's okay like that?
I think it doesn't change. Coming back to liquidity again, right? You're either allowed to buy it or not. So the authorized or accredited investor is a protection of the public, that you don't have basically scam artists selling shit to the public that they know is a scam. And accredited investors are supposed to be clever enough to figure out whether it's a scam or not. So I don't think that changes. I think the opportunity is, first of all, with fractionalization, you can, or putting on blockchain, you lower the cost of admin and operation, right? So you lower the barrier to entry from a pure economic perspective. You make things economically viable that weren't economically viable before that. Now, then you can start offering it to the public, but then you still need to have those rules in place at the basic level of the security. You need to do a prospectus. That doesn't change, right?
Unfortunately.
No, I can't see it happening because, I mean, I think many people got burned, right? Also if you look at FTX saga and stuff like that, lots of retail people got burned. Nobody really hears them because there's no access to press releases and media and things like that, right? So arguably nobody cares. You put your money into a casino, you can hit the wrong color. Lots of institutional traders and infrastructure has taken the approach to, okay, well, let's start doing what the normal world does. Let's start segregating custody from trading as a starting point. Let's take away this role. We don't want to have the exchange also being the custodian of our assets. And that's what's happening, and there's good reasons for that. So, yeah, I don't think there's anything new, right? In the sense that the laws are there not because of a lack of technology. It's just with the technology we can make the enforcement of those laws and the protection of public, we can automate that and make it cost effective for much smaller tickets, which democratizes access to these financial instruments and the yield that in the past people couldn't get access to, and mobilizes capital towards investment objectives that currently were not fundable because it relied on KYC by banks who didn't want to invest in KYC because of that reason, right? So I'm very optimistic about what that does, but it doesn't change anything on regulation. So.
No, I agree on that. And I do agree, even if I dislike the outcome, unfortunately, because I think that indeed like what you're saying, that like we open up the market to services and products that were not available before, but at the same time we still allowed only a very specific number of individuals to access this type of products through, the fact that you need to be an accredited investors and all that stuff. And what you're mentioning is very true. We have like FTX, we have Celsius, we have BlockFi, we have like whatever numbers his name is in place and so on. But as an Italian, for example, there is the list of banks that have completely default and random people that lost like insane amount of monies and so on. So it doesn't obviously provide a point in favor of crypto, but I don't think that the current like regulation environment in general like avoid those type of problems, because the traditional finance space in general has the same type of issues that we're seeing in crypto as well. But again, I do agree with your entire analysis, because I do see the same outcome in the end. Again, unfortunately for that.
The interesting thing is with the stable coins under MiCA, and I'm looking at that, discussing the regulation every day, is that you can use a euro stablecoin wallet on MiCA as a bank account, right? You don't get yield on it, but the banks don't give you that anyway at the moment. And that money is safer than putting it in the bank, because let's say the business model for these stablecoins, part of it relies on yield from government bonds. So the issuer will put it in 70% of it in government bonds, which is a lot safer than a bank bond, which is effectively what you do when you put your money with a bank. Right? And then if you spread the cash leg, the cash amount amongst multiple banks, your risk of a complete failure is a lot less. Some of the institutional parties that we talk to, they're saying, well, it's really unfortunate that you have to keep it in cash, because we'd much rather have you custody your assets in government bonds, because it's safer. So I think we are creating a much safer alternative than the existing banking system, just through this custody.
That's fair.
And regulation enables it.
Till they don't change the rules and allow it only for the 10% back like they've done before. everything else. But
The
no,
bank,
that's a
the,
point taken.
yeah. Well, no, the banks they exactly they stay the same, but as an EMI, we have to be 102% backed as a minimum. We need to prove it every day, and if that changes, I'll probably go to jail, right? Because that's the rule.
That's fair.
That's beautiful, guys. That is some very positive information. Ed and Kay, you guys have anything to add to this?
Okay, so yeah, for just listening to your conversation, guys, I think we're still far from the ideal, transparent, and the ideal state that we're hoping for, but we're already far from what is like the traditional ones that we've had. So yeah, I think we're still looking for it. We're still looking for the future. We're still far, but yeah, it's very nice to have you guys here, especially that we're all in the same space, and yeah. So that's the only thing for me. Ed.
Yeah, I don't have any more questions.
Okay. I do have a couple of. I know you guys are very busy, and we're trying to, of course, have this in the most efficient time as possible. I have just a few follow-up questions here, right? I actually do want to get back a little bit to the KYC part because I think that's going to be a crucial thing. But since we are on the topic of also the demand side for RWAs, right, which is essential. I think Stefano already mentioned the accreditor investor part, and then Arnoud also kind of confirming, okay, this is going to stay, this kind of regulations, but actually the regulations also allow now the new kind of innovative companies to offer more safe alternatives, at least to keep your money. So that is, I think, very interesting information for everybody listening to this podcast. But I think for project owners and companies that are, either considering the RWA space or trying to develop something in this space, what do you guys think how the demand will develop? Because there's quite some aspects involved in this, right? Not just like the consumer demand, which indeed we also have seen many projects in the crypto space try to tokenize a lot of different assets, including real estate and other assets, and the demand has been quite limited from a user, just like a individual perspective, because literally not every crypto investor is even interested in holding any real estate or anything like that. And that probably won't change. Just like not everybody's interested in startup investments. That's just a small group, and part of the small group is the accredited investors, and some that might want to invest are not accredited, and there's definitely frustration, and I totally get where Stefano is coming from on that. But that's probably, like you guys were just discussing, kind of a parallel path of kind of innovation and progress within the regulatory space itself. But RWAs obviously also have other use cases, right? Like they have DeFi use cases. They have, for example, even stable coins. I can assume they can be connected somehow to the RWA space as well, right? To kind of diversify their asset backing. So how do you guys see that? Because do you see the huge market for adoption based on the back end, based on these kind of institutional connection and maybe DAO or organizational adoption of RWAs? Or do you also think there is also part of market growth in kind of individual investor adoption as well? How do you guys see that?
Arnold, you want to go or I go first?
Yeah, no, I'm just processing the introduction to that question. I think it comes back to liquidity ultimately. Like it comes back to the journey of liquidity. It's currently we've seen great take up in cash, US dollars, and that becomes a standard. We haven't seen as much in euros, but that's because US dollar was there. Funnily enough, it's the take-up of a stable coin is complementary to the country that the currency is from. So US dollar stable coins, I don't think adoption in the US is that big, to be honest. It's mainly outside of the US. That will be interesting to see what happens in the EU with whether the euro is going to get big take up in the traditional crypto markets. But there is liquidity. Same with bonds. There is liquidity, right? So if you are holding it and you want to exit it, you can do that. So I think that's still going to drive a lot of the investor appetite. Ultimately, I looked a lot at financing commodity supply chains using on-chain capital and connecting the two, but the step is quite big between tokenizing a shipment of copper and getting somebody to pay lend 1/10 of the value of their shipment for that period, right? So that step is too big. But if you express it as a trade finance asset, you say this is the tenor, you're locked up for 2 weeks, and you get 10% yield, and you can simplify the explanation in such a way. I think that will start driving interest. Now, some investors will look at what is the underlying asset, and you say, well, it's an investment grade commodity trade flow. Oh, investment grade, okay, that's fine then, right? So there's a bit of standardization in terms of the classification of the risk that people are then able to rely on. So if I go to a website, or if I put on a website a money market fund investment grade gives you 3% yield, and a trade finance asset investment grade gives you 12% yield, and you're going to put in 50 grand, you're going to go for that other investment grade one with the high yield. It makes it very simple. So it's the way you present it, the information is going to, I think, and simplifying it, removing the complexity of the underlying structures is going to be crucial. So that standardization in terms of risk classification, I think, is going to be a big enabler.
On my side, I think that it's also a matter of like people interest, and I'm taking as an example the tokenization board, but like the previous ICO run, or the previous bull run that we got, where NFTs were obviously the thing that everybody wanted and so on. Before the NFT mania, I never met a collector in my entire life, to be honest. Like none of my friends actually never cared on collecting anything. But obviously with the NFTs, it seems like everybody needs to be a collector on this and that and so on. Which I find obviously a little bit weird to be polite on the wording, because realistically, people were there because there were money to be made. They didn't care about the art, they didn't care about the community, they didn't care about anything, and we're seeing that now, that obviously prices are down 99.99%, and those communities are borderline all gone. But the storyline was that everybody was a collector, and that was a market, and it was a gigantic market, which is not true. The art market itself is, a lot of people, very few people that collect a lot of things. And a lot of rich people also that do that. So, we always need to consider like the type of market that we're in. I do think that, and again, it's kind of actually be considered a little bit of a tokenization thing. If I'm taking the USDC with what Coinbase is doing, the fact that now you can park USDC into the Coinbase app and receiving like 5.15% APY, that is to me a fair option instead of having those money sitting in a bank account in a very simple terms, because Coinbase gives me 5.15%, and that's exactly what Arnoud was mentioning, while DBS here in Singapore, if I'm investing into T-notes, give me 5% APY. So I get a 0.15% more if I'm still having American dollars either way in reality, but in one case I put them into DBS and in another one I put them under Coinbase. Which one is more stable, which one is more secure, and so on and so on. But there is obviously the conversation on which like adoption can happen if the return of investment is higher on one side or another. But you know, those type of activities, I can totally see that as a mass market type of thing. But if I'm thinking about like the tokenization of watches that we were mentioning and so on, again, during COVID, it was like absolutely the bubble. Everybody needed to have a watch and so on. But realistically, I know like 5 people that had like luxury watches before that. So I think that we also need to be a little bit realistic with what type of market we're talking about, because from a marketing point of view, it seems like, you know, every single idea is going to go at $1 trillion and so on and so on. But one thing that I can say in terms of like usage and possibilities, because you were mentioning like not everybody wants to be into real estate, and that I totally agree. But in the comparison between like being within the real estate space, I'm taking this US company as an example called Realty. And so what they do is that they take real estate, they put that into an LLC, and you can buy pieces of these LLCs. They manage the real estate property for you, and they give you the weekly rent out of that. If you're comparing that to rates, for example, you don't get a weekly dividends out of that. But then they brought that to a step further, which is like they created a DeFi system, which is called like YAM, I think it is, where what you can do is like taking that share of an LLC that you own, you deposit that, and you receive a loan in return for that, which obviously you need to pay the interest and so on. And people can deposit their stable coins and receive an API in the same way that you would do on Aave and so on. So now you're in a scenario in which like you can invest into real estate, you can collateralize that, you can receive a loan, and you can do all of this in a matter of literally minutes in reality. While in a normal case scenario, if I would own a real estate, an entire property, I would need to go to the bank, ask for a loan or a mortgage and so on and so on. And the entire process would be like more complicated and way bigger in terms of fees and so on and so on. So again, you can enlarge that market, yes, because you get a better use case and a way superior workflows. But again, what you, Rob, are mentioning is that if I'm not interested in real estate to start with, I'm not going to start investing into real estate later on. So I think that we need to kind of address the aim a little bit on the reality of the market.
The composability is a game changer, right? So I think that's very different because you can do it. It creates a lot more flexibility, and you could let robo advisors create a tailored portfolio for you based on a certain yield strategy, and say diversify it across 10 different asset classes, and you don't care which asset classes they are, and it will calibrate it every day. I mean, that's a fantastic type of product. But also other aspects. I mean, if you have a yield-bearing, let's call it a yield-bearing stablecoin or a security, something that is, you've got different models, right? Delivery versus payment. You can do payment versus payment, but you can also do delivery versus delivery. I can just use that to pay someone for a service, that yield-bearing stablecoin. In the old world, I would need to liquidate my high-yield position with the bank, take the penalty, turn it into cash, wire it to somebody else, right? And then the other way around. So that kind of stuff is going to create a lot more utility for these assets, which, again, in theory, should enlarge the market, but we haven't seen that yet.
So many amazing things here, guys. I think there's a lot of content to do multiple more episodes on this. But we do have to close it off soon. And by the way, let me just take the liberty a little bit to kind of maybe summarize for our audience. So what I understand from both of you regarding this question of the demand side of RWAs is that actually it can be driven also by the consumers based on indeed the communication of yields, because the enabling of more diversification and more access to different types of assets through RWAs. And like Stefano rightly said, we had a DeFi summer before based on these conditions that, Aave and YEarn and Compound were driving great yields for people. That's what's driving demand, and thus which is linked to the whole RWA opportunity. So quite interesting. And then on top, Arnoud, what you're saying, if you combine it with robo-advisors and AI and all that kind of things, it's quite interesting. Plus the fact that you even yield-bearing assets you can potentially tokenize and stake and transact with. So there's a million different things. But I would love, before we close this episode real quick, because I know you guys in your day-to-day operations, the KYC around RWAs is definitely a thing. How do you guys see that developing? Is there any updates on that, also in the technology, in terms of like doing that in a privacy conform way with zero knowledge proof, and of course the UI behind that? Can it be actually on the blockchain, the whole KYC process? How do you guys see that developing?
Yeah. Shall I go first, Stefano, on this one?
Please, because I'm not gonna be polite on this one, because I don't have a very nice opinion on this.
KYC is a massive pain for everybody, right? But because it's so painful and so many parties are suffering it, you actually, on the retail side, you've got pretty good solutions now, and people are getting used to onboarding with services that involve payments or finances. You log on, you show your face, you move left and right, and that's that user experience from having to go to a bank, verify your passport, queue and things like that. That process is completely transformed. So KYB is hard work, right? If on corporates, particularly then looking at politically exposed persons, sanctions, all that kind of stuff is really, really nasty work. But even there, you're getting multiple providers. So I was at ING a number of years ago. Let's say 7 years ago, KYC was a massive pain point. There was no automation. Everybody had their checklist. Documents were submitted individually. It was just a massive pain point. There were no providers out there in the market that could help with that. Walking around Money 2020 3 weeks ago in Amsterdam, I spoke to at least 20 providers that are providing solutions, APIs into global databases, etc. So it's changing, and because the pain and the cost is so big, it will get better and better. Now, if we all start relying on the same databases for this and the same information, then suddenly, if you've got this virtual single version of the truth, you could formalize it in an actual single version of the truth, which is a blockchain provides that, right? So the end game will be on something like a blockchain. Absolutely.
KYC dedicated blockchain.
Not necessarily dedicated blockchain. I think we've done enough layer ones, right? I think it's more about having a blockchain. The function of blockchain for me in this topic is ensuring the integrity of data that you are not involved in creating, right? And that you can base your decisions on with confidence. And that federation of integrity, blockchain is a perfect technology for that.
So the end game is a single, preferably database to blockchain storage for your data, which you can easily share with different applications on the internet.
Yes, and decentralized. It has to be blockchain, not just because there's no way you want, for instance, the US government necessarily to be the custodian of the worldwide database of KYC, right? So it has to be decentralized with decentralized identity control as well. So the control over the information, not necessarily the accuracy of the information, but the disclosure of that information sits with the owners of the information, not with anybody else.
That would really simplify things a lot. Because one thing that I noticed of like what you're describing is that Europe in general, to me, is like one of the best environment that there is in terms of like KYC regulations and technology. They were some of the first ones to like implement on FIDO, for example, and so on. They were really, really understanding things and so on. But for example, what you're mentioning of like, you turn your head around and so on. A country like Seychelles, for example, doesn't even allow you to do that. You can't. And so yes, we have the technology, but the law is not there. And on top of that, the countries all have this thing that they think that they know it best. And so you have set of rules number 5 where you need to have like this and this, and then another country requires you other type of information that you need to get, and then other countries requires you something else again. And so every time that you're dealing with KYC at a multiple country level, let's say that you have one client, one individual, and then you need to do KYC at like levels of 3 different countries, you might end up having to ask your clients 3 different times for more information because like the rules are different, the laws is not in place, and so on and so on. Answering Rob questions, I do see that getting worse, to be honest, rather than better, mostly because like on a day-to-day I'm seeing that rules are just piling up. Even if we're taking the US as an example, which traditionally has always been very relaxed on KYC and so on, this year they implement the register of beneficial owners. So now every single person that has a company in the US needs to actually provide their information to the US government. So it's like every year there is like a new set of things that pops up, and every year it becomes like more messy and more complicated and so on. Even in terms of like tech, what I noticed is that a big push that we got, at least like as a service provider in Singapore, was that a lot of the documents obviously that you obtain needs to be certified. You need to make sure that like the passport is a true copy and so on. And a lot of the apps that do these type of things, they don't issue certificates. Why? Because they don't want to take the liabilities. And so when you are in those type of scenarios, you're in the situations in which like the tech can actually do the work for you, but you can't even use that because ultimately you still need to certify the original document on your own. If the tech then start providing a certification level, so for example, us, we use BlockPass which is crypto related, Web3 and so on, for our compliance matters and so on. But we got audited because as a filing agent, we're getting audited every single year from Deloitte. And so we're not talking about like the first company in the world, we're talking like one of the big 4, obviously. And Deloitte had no idea how the KYC from a technical point was, well, not Deloitte as a company, but the auditor from Deloitte had no idea how those things were working. And I had to spend 2 hours to explain the KYC process done in a virtual way. And we're talking about Singapore. We're not talking about the third world. So again, it is absolutely a mess. What you're describing, Arnold, as like a potentially one database, one thing that actually worked for everybody, that would be a dream come true. That would simplify so much work. And apart from that, also at the compliance level in terms of like sanction list, criminal records, PEP checks, all of that stuff, if you have one central piece that where all the informations are there, then you can go to every single lawyer, every single register, every single service provider and be like, this is the standard, you don't like it, you're gonna accept it either way. It would make like things so much easier. That is so required in the space. But unfortunately, I think it's super utopistic. I don't see governments or service providers being like, oh yeah, let me change what I've been doing for 30 years and doing innovation and learning something new, because people are lazy, unfortunately, on these matters. So it's like it's something that at core boils me, unfortunately, because it really frustrates me so much.
Yeah, it will get better, worse before it gets better. I would
I hope
I would agree with that. But in a way, it happens in supply chains as well, right? Compliance with regards to, for instance, if you're moving a ton of copper around the world. In the old days, it used to be what's the quality, the chemistry of it, how much, right? And where is it now, and where is it going to go to? That's That's roughly it. Now it's okay. So who produced it? What certification did they have? Who held it before? What's the provenance? What's the emissions content? What's the location now? So there's a lot of digital content associated with the physical material that suddenly gives value to the physical material, more value than the innate chemistry. And so what that does is, if you cannot provide that type of information and in a way that is easy to consume, it reduces liquidity for your product. Coming back to liquidity, it means it reduces the markets, access to markets, reduces prices. So I think that same thing will happen in this KYC world, where if certain jurisdictions continue to not have access to markets because of the way they work, their people will demand the change, right? There will be change and there will be conformity, there will be that information, because otherwise it's just the price is too high. If you can't buy a tokenized real world asset on the exchange because you come from a jurisdiction that doesn't supply the information, at some point you're going to try and provide that information. And so it's a simple, the game will turn around. And if you provide the standards and the tools, etc., to do it efficiently, I think that access to liquidity, access to markets is going to be a value driver that is too important to ignore. But anyway, it will get worse before it gets better.
We're just gonna keep shouting in the meantime, basically.
Any time frame, guys? What do you guys? It will get worse before it gets better, but what time? Are we talking years? Decades?
I would say decades, to be honest.
Yeah, I don't think it will be this decade.
But I think we dropped a lot of, or you guys rather dropped a lot of extremely valuable information in this podcast. So thank you very much also from our audience. And we have to leave it with this for now. Hopefully we can organize another one in a little while. Thanks everybody for listening and watching, and see you next time. Goodbye.
Thank you, Rob. Thanks. Okay, thanks, Ed.